In this video, I will discuss how imbalances can cause the markets to move. As I explained in my strategy guide, markets move when there's an imbalance between supply and demand or demand and supply. In other words, more buyers than sellers, more sellers than buyers. And if we're in an uptrend and there's strong buys, market might have trouble absorbing it, creating an imbalance to the upside. And vice versa. If we're in a downtrend, more sellers come in and the market has trouble absorbing it, creating an imbalance to the downside. Of course, if somebody comes in and sells in an up market may be able to absorb those more readily. But the point is, when you have an imbalance in the market moves. And the strength of the amazing trader, through its ladder lines, can identify when there is an imbalance and lines are building in one direction or the other. And we have a strategy to trade them, because the market is going to be looking to buy dips or sell blips, the case may be, as it absorbs whatever trying to absorb whatever imbalance there is and trying to restore it to equilibrium. So let's take an example, an illustration, a simple one. We're living in a bubble. There are two traders, you and I. We're at 122.45. Or I sell euro with a 10 pip stop. You buy euro with a 10 pip stop, a 10 pip profit target, goes to 122.55. I get stopped. You take profit. We're back to equilibrium and a balance. However, what happens if we add a new element? At 122.50, a sovereign wealth fund comes in and buys euro for some sort of investment, say buys 3 billion euro. All of a sudden, there is an imbalance in the market. The market has to absorb those 3 billion euro because it's not coming back. Not unlike you and I, who might be day traders who have to square up at the end of the day. This money's coming out, may not come back for 3 months, 6 months, a year, or 2 years. Those funds are gone. The market has to find a way of restoring that imbalance. Now, as that occurs, you'll start to see the market move higher. We don't know where the imbalance comes from. We don't know where the order comes from. Through the amazing trader, we only know it's occurring. So the key here in this bubble example is that there were funds taken out of the market. We look at the market as everybody's a speculator. That's not true. The real money, and you've heard that term, real money, is what really drives the market. And if you can identify when that real money is coming through, and you don't have to know what it is, all you have to know is that it's occurring. That's why you get those straight line moves that I've explained, is because the algo sends some large order that the market is having trouble absorbing, and it's going to run with it. Either they're going to front run it or pull back their offers until they get to levels that draw in sellers and restore the imbalance. Now, you could have a bank working the order, and it works it very skillfully, and it's not evident that order is being executed. But once it's executed, it's created an imbalance in the market, and again, you start moving up or down. So just think of imbalances as driving the market. The amazing trader recognized the imbalance, and we have a way of trading it. And that's why I say, if you buy a dip when there's an imbalance with a stop below the most recent amazing trader line, you got the market on your side. As long as it's not executed, the risk is pointed in that direction until it reaches a level that restores the imbalance.